Welcome to Team Banana Stand's presentation on the future of shadow banking in China. Team Banana Stand is David Coburn, Stacy DeVolder, Ayobami Olaleri, Felina Stack, Amber Zanin, and myself, Steve McRae. We intend to show you the positives and the negatives that coincide with shadow banking, and talk about the possible future of shadow banking, specifically in China. Already a $75 trillion industry, what exactly is shadow banking? Shadow banking is the financial intermediaries involved in facilitating the creation of credit across the global financial system, but whose members are not subject to regulatory oversight. The shadow banking system also refers to unregulated activities by regulated institutions. Shadow banking encompasses a cornucopia of non-bank financial products such as peer-to-peer lending, derivatives, securities, and wealth management products. The former Federal Reserve Chair, Ben Bernanke, explains shadow banking as a set of institutions and markets that collectively carry out traditional banking functions, but do so outside or in ways only loosely linked to the traditional system of regulated depository institutions.
Many believe that the unregulated banking sector will continue to grow in China. In the buildup of the 2008 financial crisis, financial institutions found themselves unable to meet the growing demand for credit. Shadow banks provided much-needed liquidity to individuals and businesses where the banks were unwilling or simply unable to do so. Shadow banking also allows small to medium enterprises, or SMEs, to secure credit. In China, SMEs account for 99% of the business market, yet account for less than 20% of bank lending. In essence, shadow banking allows more people or businesses to receive credit. It is meeting a need in an underserved market. To date, China has been slow to take action to remove bank restrictions and regulate any shadow banking channels. As the economy grows, or as SMEs with existing credit require additional funding to service their debts, the lack of action will help to provide growth in the Chinese shadow banking system. Also of note is that the local Chinese municipal governments are restricted from borrowing money to raise capital. This, in effect, is forcing these governments to use shadow banking to generate necessary capital budgets. It is not unreasonable to suggest that if strict regulations were put in place, without alternative channels of credit, local governments would likely be stifled. In the absence of strict regulations governing all aspects of lending, it is likely that shadow banking will continue to grow as the lending vehicles become more innovative and the economic outlook remains positive. Enter Yuebao, an investment service launched by Jack Ma, founder of online retail giant Alibaba, in June of 2013. The service allows individuals to transfer funds instantly into their Yuebao account via Alipay, China's version of PayPal, and earn between 5 to 7% on their deposits, eclipsing the measly interest rates offered by the banks. The funds invests in China's 4 major commercial banks and has become a major supplier of funds, allowing it to earn the rates offered by higher-end WMPs. Further, Yuebao offers perfect liquidity. Consumers can invest or withdraw funds on their smartphone instantly without penalties or lockup periods. Within a year of launch, the fund had become the 4th largest money market fund in the world and accumulated $92 billion. Meanwhile, government regulators are slow to act, worrying that placing restrictions on this type of investment could cause consumer uprising.
Shadow banking has also provided additional long-term benefits by spurring much-needed innovation in the regulation of financial markets. In China, financial institutions primarily lend to low-risk state-owned enterprises who are backed by implicit state guarantees. Alternatively, shadow banks have provided SMEs with innovative credit vehicles such as guarantee companies, leasing companies, and peer-to-peer funding. With little interference from regulators, shadow banks will continue to create innovative lending vehicles that will meet demands of the market. Tony James, president of private equity firm Blackstone, says, "Putting that negative definition of shadow banks out there is dangerous for the market. Distributing that risk is essential for banks to free up capital, because without it they would not lend money." Chinese investors poured funds into trust products last year, boosting such assets to record $1.8 trillion. This comes less than a month after China averted its first trust default in at least a decade. So does shadow banking, particularly in China and India, pose a threat to the global financial system? Rosalind Chin of Bloomberg Business reports.
Shadow banking is worth more than $70 trillion across the globe. It isn't just about risky investment products and lending between individuals. Shadow banking also covers loan shark operations and pawn shops, as well as what are considered more respectable activities like derivatives and securities lending. What makes them shadowy is that they operate outside the regular banking system, and that means it's often not controlled by regulators. The Financial Stability Board says shadow banking poses systemic risks to the global financial system. The prevalence of shadow banking makes it difficult for governments of countries like China and India to control their economies through tools like interest rates or money supply. Let's take a look at China, where shadow banking looms largest. It's estimated China's shadow banking sector is worth $6 trillion, about 69% of the economy. That's because saving deposit rates in China are low, and most small businesses can't get bank loans and so turn to other sources of lending. China tried to rein in wealth management products last year, resulting in the worst cash crunch in more than a decade. Rosalind Chin, Bloomberg, Hong Kong.
As previously stated, a major driver of shadow banking is the challenge that SMEs face in obtaining financing. For these businesses, the high-interest loans provided by shadow banks subject SMEs to unreasonable financial pressures. With shadow banks providing approximately 50% of China's lending, these high-risk loans and their increased potential for default introduce significant economic uncertainty in the financial markets. The government has implemented certain measures that may qualify as regulatory reform. For example, a recent push to curb the risky off-balance sheet financing appears to be having some positive effects, as data on new debt issued through the banking system indicates a slight rebound from a dip in 2014. With shadow banking growth figures at 14.2% in 2014, down from 35.5% growth in 2013, it's not unreasonable to suggest that the regulatory reforms are working to encourage less risky lending. The increased attention on China's numerous forms of unregulated lending channels presents a negative long-term outlook on the viability and growth of shadow banking. To dive deeper into some of the issues, here's an example from 2014 involving loans and wealth management packages. Many of these risky loans are bundled into wealth management packages, or WMPs, which are purchased by wealthy investors who perceive them to be effectively guaranteed. These investments then feed the off-balance sheet trusts that further fund the shadow banking system. However, WMPs are not free from risk. For example, in 2014, a $495 million principal of a WMP was at risk of default, and the bank that sold the WMP initially declined to back the loan. Ultimately, in an effort to maintain investor trust in WMPs, the bank coordinated the recovery of the principal through the sale of assets. Although this appears to have soothed investors' fears for now, it has nurtured a false sense of security in WMPs.
The World Bank has cut its growth forecast in China from 7.2% to 7.1% in 2015 and from 7.1% to 7% in 2016. This outlook highlights China's inability to contain the issuance of debt and limit the shadow banking sector. In addition, a recent survey of SMEs revealed that for 3 straight months, export orders were hit by their sharpest decrease in 3 years. If these conditions continue, SMEs may be unlikely to generate the revenue needed to meet their obligations, resulting in defaults that could break the backbone of the Chinese economy. Since the 2008 financial crisis, assets, or loans to individuals and businesses, held by China's financial system jumped from $8.3 trillion to $23.3 trillion in just 5 years. This graph depicts the amazing increase in loans, bank acceptance, and corporate financing. Anne Stevenson Yang, co-founder of Beijing-based J Capital Research, estimates that 60 to 70% of new lending is directly for the purposes of servicing old debt. Today, it takes $3 to stimulate $1 of economic growth in China, whereas just 9 years ago, the same could be accomplished with a mere $1.20. Yang's research also indicates that China's debt appears to be outpacing GDP, which can be an indicator of an increase in the rate of credit defaults. Ultimately, a slowdown in the economy, coupled with the uncertainty provided by high debt loads, may reduce lenders' appetites for high-risk loans. As depicted by the graph, shadow banks have helped boost China's debt level at a pace that mimics the rise seen by other nations ahead of their financial crisis. Furthermore, China's real estate market is also slumping, with the latest information indicating that prices have fallen by 20% in the last 12 months.
In China, shadow banking has gained momentum over the years, growing to around 70 to about 100% of Chinese economy's GDP, or something comparable to 6 to 9 trillion US dollars. However, the future of shadow banking is largely dependent on the health of the Chinese economy, with indications of a slowdown in the Chinese economy and concerns over the lack of a regulatory framework. A shadow is being cast over the future of this alternate banking instrument. Now, furthermore, the fraudulent practices associated with shadow banking pose a risk to the health of the Chinese economy and create greater uncertainty in global financial markets. Now, a central problem is the reliance on debt-funded economic growth. Today, 60 to 70% of new lending is directly for the purpose of servicing the old debt. To sustain China's expected growth target, annual increases in credit must exceed 20%. This figure seems to be an unfathomable expectation given China's current economic activity. The increase in the size and complexity of the shadow banking sector reflects broader structural problems that continue to plague the Chinese economy. Now, to protect the stability of China's financial markets, the government will need to identify and, of course, to implement appropriate regulations in the near future. The disparity between the strict regulations facing banks and the seemingly non-existent oversight of unregulated lenders is too cumbersome, even for a country like China. The increased attention on China's numerous forms of unregulated lending channels presents a negative long-term outlook on the viability and growth of shadow banking. There has been much debate about the impact of shadow banking and its effect on the Chinese economy overall. Arguably, shadow banking has driven the Chinese economy for several decades, catering to the needs of small, medium-sized organizations. However, it likely contributed to the 2007-2009 global financial crisis. Now, following the crisis, shadow banking continued to gain momentum in China and remains a formidable financial instrument to conventional banking. However, under mounting pressure to address the high debt levels and rein in the shadow of and the shadow banking system, China appears committed to introduce meaningful financial reforms to help stabilize the economy. This presents a serious barrier to the growth of shadow banking in China, of course. Nevertheless, only time will tell if attempts to regulate and restrict shadow banking will slow down its growth and have the desired outcome, which is economic stability and also a transparent financial sector. On behalf of Team Banana Stand, I would like to take this opportunity to thank you for viewing our presentation. I hope you find it informative, yet concise. We would now like to open up the floor to any questions you may have. Thank you.